Imagine this. The world's richest nation, the United States of America, standing at the top of the global economy, yet drowning in debt. The irony is staggering. The same country that prints the world's dominant currency is also the biggest borrower on Earth. Trillions in the red, and still asking others to chip in. Today, that's exactly what's happening. Washington isn't just managing its own problems. It's leaning on its allies, countries like Japan, Europe, and Canada, to keep buying U.S. debt and, in effect, keep the dollar standing tall. It's like the friend who throws lavish parties on credit cards, and then asks everyone else to help pay the bill. But here's where it gets even more disturbing. The United States isn't just asking politely, it's pressuring. It's telling allies to make moves that could actually hurt their own economies, all so that the American system doesn't crack. Think about that. The world's biggest debtor, demanding that others weaken themselves to keep it afloat. At first glance, it might sound like another trade negotiation, but it's not. This is power politics dressed up as economics, a financial tug-of-war that could reshape who really runs the global market. Because this time, America's main target is one of its oldest and closest allies, Japan. And Japan is done playing nice. For decades, Tokyo has been a loyal economic partner, holding over $1 trillion in U.S. debt and keeping trade channels open. But the patience is wearing thin. Behind closed doors, Japan's leaders are saying what few have dared to say to Washington in years. Enough. This isn't a normal disagreement, it's a standoff, one that could shake the global financial order to its core. Because for the first time in modern history, Japan isn't just resisting U.S. pressure, it's preparing to strike back. To understand why this confrontation matters, we need to step back and look at the machine driving America's power and its weakness, at the same time debt. For decades, the U.S. has built its wealth on borrowing. Government spending has ballooned far beyond tax revenues, and now the country runs an eye-watering current account deficit of 3.8% of GDP, roughly $1 trillion every year. In plain English, that means America buys more from the world than it sells, and it pays for that difference by borrowing from everyone else. Here's how it works. The U.S. Treasury prints bonds, which are basically IOUs promising to repay investors in the future. Foreign countries, like Japan, China, and many European nations, buy those bonds because they trust the U.S. dollar. That demand keeps the dollar strong and interest rates low. But here's the catch. The more America borrows, the more it depends on others to keep believing. It's a bit like a popular influencer who lives entirely off brand deals. As long as the sponsors keep coming, everything looks perfect. But once the sponsors start to pull back, the illusion fades fast. And that's what's starting to happen. In recent years, foreign investors have begun losing faith. Central banks are trimming their U.S. bond holdings, shifting instead to gold, euros, and even Chinese yuan. In fact, about 30% of America's treasury market is owned by foreign buyers, meaning if they slow down, Washington suddenly faces a financing problem it can't ignore. To make things worse, the dollar has already lost 10 to 11% of its value in 2025, making those same bonds less attractive. For investors abroad, that's like watching their savings quietly shrink just because the currency slipped. Economists call this shift de-dollarization, countries diversifying away from the greenback. And while it might sound like a technical adjustment, it's really a vote of no confidence in America's financial leadership. The problem is, if the rest of the world stops buying U.S. debt, someone else has to fill the gap. That usually means the Federal Reserve steps in and prints more money, which can weaken the dollar even more, drive up prices, and spark inflation at home. So when Washington pushes its allies to keep buying U.S. assets, it's not about partnership, it's about survival. And one of those allies, Japan, is starting to question whether it should keep footing the bill for America's endless borrowing. Because when the money stops flowing into the U.S., it's not just America that feels the shock, it's the entire world economy. And that's exactly where this story starts to heat up. By early 2025, the situation in Washington had become, well, pretty desperate. The U.S. Treasury faced yet another round of massive bond sales, and global appetite was fading fast. Domestic buyers weren't stepping up either. Participation had dropped to its lowest level in years. So the White House turned to one of its most reliable financial partners, Japan. But this time, the tone wasn't diplomatic, it was demanding. Officials from the Trump administration began pressuring Tokyo to do its part for global stability. In Washington's language, that meant raising Japan's interest rates and strengthening the yen. On paper, it sounded like a technical move. In reality, it was something much bigger. Here's what the U.S. was really saying: help us keep the dollar strong, even if it hurts you. The logic went like this. If Japan made the yen stronger, Japanese exports like cars and electronics would become more expensive overseas. That would make American products more competitive, closing the trade gap between the two countries. At least that's how the U.S. framed it. But beneath the surface, it wasn't about trade fairness at all. It was about supporting the dollar. A stronger yen might ease U.S. inflation pressures and draw global investors back toward American assets. For Washington, it was a quick fix. For Japan, it was economic suicide. Japan's economy, already fragile, couldn't handle it. Growth had shrunk by 0.7% in the first quarter of 2025. Exports were down. Household spending, which makes up more than half of Japan's economy, had flatlined. Ordinary Japanese families were already struggling with rising costs and stagnant wages. Raising interest rates now would only make things worse. Higher loan payments, weaker exports, and fewer jobs. It was as if a drowning swimmer were being asked to carry someone else on their back. So when Washington delivered its message, through official channels and Treasury reports, Japan heard something very different. Wreck your own economy, or we'll do it for you. Behind closed doors, Japanese officials began pushing back. Bank of Japan Governor Kazuo Ueda warned that the economy was far too weak for aggressive tightening. Politicians whispered about American arrogance, and for the first time in decades, Tokyo's patience started to crack. Japan, long seen as the loyal ally, the dependable financier of U.S. debt, was beginning to draw a line. Because this wasn't cooperation anymore, it was economic coercion. The tension didn't take long to explode. When diplomacy failed to get Japan in line, Washington reached for a blunter weapon: tariffs. In the spring of 2025, the Trump administration slapped a 25% tariff on Japanese cars, one of Japan's most vital exports. The impact was instant and brutal. Within just 2 months, Toyota lost an estimated $1.3 billion, and its earnings forecast was slashed. Mazda, facing the same uncertainty, delayed its financial guidance altogether. Factories slowed production, suppliers froze new hires, and investors panicked. For Japan, this wasn't just an economic blow. It was a message: comply or pay the price. Supporters in Washington called it leveling the playing field. But in Tokyo, the mood was far darker. Japan's media described it as economic warfare, a calculated strike against one of its strongest industries. The car sector isn't just another line on Japan's GDP chart, it's the backbone of its modern identity, employing millions and symbolizing decades of industrial pride. To understand how serious this is, imagine if someone targeted America's tech industry, imposing heavy taxes on every iPhone or Tesla leaving U.S. ports. That's how deeply this hit Japan. The numbers told the story. Exports dropped, consumer confidence slipped, and smaller manufacturers, many dependent on U.S. contracts, started cutting hours. Economists warned that another shock of this scale could tip Japan into full-blown recession, and yet the U.S. kept up the pressure. American officials argued that these tariffs were temporary, a way to encourage Japan to adjust its policies and raise the yen. But behind the scenes, Japanese leaders knew the truth. This wasn't encouragement. It was punishment. Inside Tokyo's government offices, the frustration boiled. One finance ministry official reportedly said, "How can we call this an alliance if we're being treated like an adversary?" Still, Japan didn't retaliate immediately. Its leaders knew that any sudden move, like dumping U.S. assets or imposing counter tariffs, could send global markets into chaos. So, for the moment, they endured the pain, waiting and watching. But as the tariffs bit deeper and Japan's bond markets began to shake, patience was no longer a strategy. The U.S. wasn't just testing Japan's loyalty, it was testing its limits. And the cracks were starting to show, not just in trade, but in the very foundation of Japan's financial system. While trade tensions with Washington were escalating, a much quieter, but far more dangerous crisis was brewing inside Japan's own economy. It wasn't happening on factory floors or in car showrooms. It was unfolding in the bond market, the hidden heart of Japan's financial system. For decades, Japan has carried a debt burden unlike anything in the developed world, a staggering 236% of its GDP. To put that in perspective, for every dollar Japan produces, it owes more than $2. That's higher than Greece during its debt crisis, higher than the United States, and higher than any major economy on Earth. So how has Japan managed to survive this long? Through one simple trick: near zero interest rates. The Bank of Japan, or BOJ, has spent years keeping borrowing costs almost non-existent under a policy called yield curve control. It's like freezing time, preventing interest rates from rising, even when markets want them to. The BOJ did this to protect the government from the crushing cost of servicing its massive debt. But in 2024, that system began to crack. By early 2025, the BOJ finally ended its yield curve control policy, and the results were immediate. Long-term bond yields soared. 30-year Japanese government bond yields jumped to 3.15%, while 40-year yields hit 3.63%, the highest since the late 1990s. For most people, those numbers might sound abstract, but in financial terms, that's a seismic shift. Imagine a family that's been paying almost no interest on its mortgage for 20 years, suddenly seeing the rate triple. That's what's happening to Japan's government, except its mortgage is measured in trillions. The surge in yields sent shockwaves through markets. Investors began dumping old low-interest bonds, sending their prices tumbling. The Bank of Japan, which holds nearly 80% of Japan's government bonds, started taking heavy paper losses. Analysts warned that even a modest rise in rates could blow a hole in the BOJ's balance sheet. And here's where U.S. pressure made things even worse. Washington's demand for Japan to raise rates and strengthen the yen added more fuel to the fire. Higher rates might please the United States, but they'd devastate Japan's economy. A Deutsche Bank report estimated that Japan would need a 20 to 25% yen appreciation to meet American trade goals. But that kind of currency surge would crush exporters, companies like Toyota and Sony that depend on affordable prices abroad. Japan was now cornered. If it raised rates to satisfy America, its debt market could implode. If it kept rates low to protect itself, the yen would weaken further, pushing up import prices and inflation for ordinary families. Either path led to pain. It was a lose-lose situation, and Japanese leaders knew it couldn't last forever. Something had to give. And this time, Japan decided it wouldn't be them. By mid-2025, Japan had had enough. After months of economic strain, market volatility, and Washington's relentless pressure, Tokyo quietly began building its own strategy, a financial counterstrike. And this time, it wasn't just defensive. Instead of bowing to American demands, Japan turned outward, toward the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, or CPTPP. This 12-nation trade alliance, which the United States abandoned back in 2017, had become Japan's ticket to independence. While America was focused on tariffs and short-term deals, Japan was strengthening its long game, rewriting trade rules without Washington at the center. Exports to CPTPP countries began to surge, especially to the Middle East and Southeast Asia. In the first quarter of 2025, shipments to member nations rose 17%, driven by new energy and infrastructure deals. Japan even signed fresh trade agreements with the United Arab Emirates, aiming to reduce dependence on U.S. markets altogether. Cars once destined for American dealerships were now being shipped to Mexico, Canada, and the Gulf, a quiet but deliberate pivot. But trade diversification was only part of the plan. Behind closed doors, Japanese officials started discussing a far more powerful move, one that could shake global markets, using their U.S. Treasury holdings as leverage. Japan holds about $1.1 trillion in American government bonds, second only to China. For decades, those bonds symbolized Japan's trust in U.S. stability. But now, Tokyo was hinting that those same assets could become a weapon. In May 2025, Japan's finance minister Katsunobu Kato made a subtle but explosive remark. All options are on the table. Markets took notice. The message was clear. If Washington continued to bully Japan economically, Tokyo might start selling off U.S. treasuries. Why does that matter? Because those bonds are the backbone of America's financial system. If Japan even threatened to unload a significant portion, it could send U.S. interest rates soaring, tank the dollar, and rattle Wall Street. It would be like pulling a crucial brick out of a Jenga tower. The structure might not collapse immediately, but everyone would start holding their breath. Of course, Kato later backpedaled, saying Japan had no current plans to sell. But the damage was done. Washington understood that Tokyo was no longer bluffing. Japan was signaling that loyalty had limits, and national survival came first. At the same time, Japan began doubling down on its currency defenses. The Bank of Japan stood ready to intervene in currency markets again, just as it had done in 2022 and 2024 to stop the yen from collapsing. It also kept interest rates low to cushion households from the pain of tariffs and inflation. The strategy was simple: hold the line at home, diversify abroad, and make sure the United States knows that Japan won't be pushed around anymore. What began as quiet resistance had become a full-scale financial rebellion. Tokyo wasn't just trying to protect itself, it was challenging the old order, where the United States called the shots and everyone else obeyed. And as both sides dug in, the unthinkable question started to hang in the air. What happens if this alliance, one that held strong for nearly 80 years, finally breaks? By the summer of 2025, the partnership between the United States and Japan, one of the pillars of post-war stability, was beginning to crack. What had once been an alliance built on trust and shared prosperity now felt more like a strained business relationship held together by habit and necessity. Inside Tokyo, Prime Minister Shigeru Ishiba started framing the confrontation as a battle for national interests. With the upper house elections approaching in July 2025, Ishiba couldn't afford to appear weak. The Japanese public, frustrated by tariffs, inflation, and years of perceived submission to Washington, wanted proof that their leaders could stand up for Japan. And Ishiba was listening. Meanwhile, Washington's tone hadn't softened. The Trump administration was still pushing America First policies, insisting that allies fall in line. But the more it did, the more those allies began looking for a way out. Japan's pivot wasn't happening in isolation. Across the world, other nations were quietly following suit, moving away from the U.S.-centric system that had defined global finance for decades. Central banks were buying gold instead of dollars, experimenting with digital currencies, and expanding trade in euros and yuan. Each step might seem small, but together, they marked a slow erosion of the dollar's once unchallenged dominance. And if Japan, the world's largest creditor nation, decided to unload even a fraction of its $1.1 trillion in U.S. bonds, the consequences would be immediate. Interest rates in America could skyrocket. The cost of borrowing could soar for the government, businesses, and households alike. Investors would panic, the dollar could weaken, and inflation might flare up again. This isn't just about economics. It's about power. For nearly a century, the US dollar has been the backbone of global trade, a symbol of stability and control. But power built on trust can vanish when that trust is abused. And right now, Washington's do-as-we-say approach is pushing even its closest allies to rethink their loyalties. For Japan, this is more than a trade dispute. It's an awakening, a realization that depending too heavily on America can be a national risk. So, where does that leave the world? If Japan makes its next move, if it truly begins to distance itself from the dollar and forge new alliances, the entire global economy could shift overnight. We might be watching the first cracks in the financial order that has ruled since World War II. Because when the world's biggest creditor begins to challenge the world's biggest debtor, it's not just a disagreement, it's a rewriting of history. The question is no longer if change is coming, but how fast. So stay tuned, because what Japan does next could redefine global power for decades to come. And if you want to keep up with how this global reset unfolds, make sure to subscribe and follow along. The story isn't over. It's only just beginning.